if we see some of the economic weakness that I believe could happen, you will start to see impairments pick up, and then the discounts will be very large.
Discounts very large. Well, that doesn't sound very good. We're going to review not only this video, but first we're going to start by talking about the Taiwanese dollar, a really critical piece in the Wall Street Journal about what could happen in the economy and what to watch for. And then we'll get into this private credit comment, which relates to the other two. And that's because the foreign currency market really matters. Right now, the Taiwanese dollar is skyrocketing at a faster pace than we have ever seen since the 1980s, specifically 1988. And when the Taiwanese dollar increases, it increases the cost of things that we're trying to import from Taiwan, like advanced chips, which isn't great. But there are also other distortions that happen with this. So quickly, just to understand currency markets and how these things might operate, it's useful to I always like to think about a European vacation, okay? So let's say you have $100 and the dollar is really, really strong, like it was in the summer of 2022 as rates started rising and people were buying bonds because they wanted these high yields in America, therefore they were converting into US dollars to take advantage of some of these higher yields. The dollar was actually pretty strong. What you found was if you had $100, you could buy somewhere around 102 euros. The euro was trading for less than the dollar. It was wonderful. And what did that mean for us when our dollar was strong and the euro was weak? It meant it was cheaper for us to go on a European vacation. In other words, it was cheaper for us to buy European goods. Now, if the reverse happens, let's say a Taiwanese vacation, just to relate to this 3 Sigma event that's happening right now in the Taiwanese dollar, 2-day increase, largest 2-day increase since 88, volatility way off the charts, and it's going to lead to some distortions. Well, now let's say we want to go on a Taiwanese vacation. What does that mean for us? Well, weaker US dollar, stronger Taiwanese dollar by a good chunk. It means that Taiwanese vacation just got more expensive, which related to our broader economy, it means imports from Taiwan semiconductors just got more expensive. Now, some of this could be because of the Lutnick 25% sectoral tariffs that could be as high as, in some cases, 100%. Somewhat like we've seen with the movie industry where, everybody's like, Disney and Netflix are going to be immune to tariffs. And then boom, out of nowhere, 100% import tariff on movie production. Still not exactly sure how they're going to pull the mechanics of that off, especially with online streaming, but I guess they're going to try to figure out where the movies are produced. Anyway, this sectoral tariff worry could be getting priced into currency markets prematurely, but, probably that's exactly how the market wants to work anyway, to try to offset some of the damage or pain of U.S. tariffs that are coming potentially as soon as Wednesday on things like semiconductors. So think about this for a moment. When the Taiwanese dollar increases, it strengthens the Taiwanese dollar and then actually weakens the cost of US-based tariffs, which is kind of interesting because if, let's say, something is going to get tariffed at a $1,000 shipment, gets tariffed at $250, well, that's tariffed in US-based dollars. Well, if the Taiwanese dollar strengthens in anticipation of that, it actually gives people with Taiwanese dollars more capability of paying for that tariff because they can buy cheaper dollars. And this is actually how currency markets can sometimes weaken or enhance the strength or the pain of tariffs. In this case, the Taiwanese win in this sort of speculative movement, and the U.S. importers get hurt. You actually, when the dollar weakens, you potentially increase the inflation that we suffer because now it takes even more US dollars to import the underlying Taiwanese product. So in other words, a lot of that gets a little complicated with currency markets, but this sudden skyrocketing of the Taiwanese dollar could be because of the sectoral tariffs rumored to be coming Wednesday. However, they could also be because of institutions being caught offsides with US dollar exposure in Taiwan. Now, this could be because of treasuries or whatever else, stocks, you name it. But this is actually a very common issue that we've been facing. In April, for example, we saw the largest retail buy the dip of US stocks, but we saw an institutional unwinding of stock positions. Some of this could be because of recessionary fears, though I don't really think the stock market or bond market is actually pricing in any real recession protection right now. It's kind of like the markets are implying a 10 to 20% chance of recession, which is indistinguishable from a normal year, which is crazy given the economic headwinds that we have. So maybe potentially a little too much euphoria in markets right now, but it's okay. Set trailing stops and let it be. But what's fascinating is if Asian markets or European markets or others are trying to offload U.S. assets, especially unhedged assets like U.S. treasuries, then you could also potentially see this surge in the Taiwanese dollar. So, for example, if Taiwanese life insurance companies are dumping U.S. treasuries, then what they're doing is they're selling those U.S. treasuries, they're getting U.S. dollars, then they sell the U.S. dollars, driving the U.S. dollar value down, then they buy Taiwanese dollar to repatriate that money back home. Boom, Taiwanese dollar up, U.S. dollar down. That could be one of the explanations here. So the bottom line of this whole currency movement is that while you could see some form of shock out of the suddenness of this movement, which is not unlike the Japanese carry trade, where when you have a really sudden shift in market fundamentals or some form of trades unwinding really rapidly, you could see shock-based pricing in stocks or bonds or whatever. But beyond that, what's more important is this potentially the start or a continuation of an escape away from U.S. dollar assets, leading to greater and greater liquidity problems? That is a potentially bigger issue, I think, for our U.S. economy than just worries about this Taiwanese dollar. Now, this isn't to say that, Taiwanese dollar isn't important, okay? It's just simply to say that as Americans in the American market, we probably want to pay more attention to liquidity concerns like that video I talked about at the beginning, but also this Andy Kessler piece. Now, this is an op-ed. The economy is in a pickle. But what he describes is really fascinating about the economy. Take a look at this. What worries me is that as with the derivatives, so like credit default swaps or whatever during the 2008 financial crisis, we have no idea how private credit will do in a downturn. And it's starting to get funky. Default rates rose in February before the tariff tantrums. A weakened economy could send default rates flying, and liquidity could get even worse. So not only do you have foreign countries potentially dumping U.S. assets, reducing liquidity, but now you also have universities like Harvard and Yale dumping money as much as they can out of bonds or stocks because they want liquidity to get through potentially a lack of funding from other sources. Talked about that yesterday. If you want my opinion on the whole Harvard and whatever debacle that's going on with universities, for what that opinion is worth, you could look it up on YouTube, meet Kevin, and then just type in Trump and you'll see it for yesterday. But anyway, a weakened economy could send default rates flying. Liquidity could get worse. No wonder stocks of KKR, Blackstone, Apollo, and the Carlyle Group are down 20 to 25% this year. Plus, all isn't right on Wall Street. The window for IPOs is more or less closed. Retail investors now trade crypto elsewhere. Wall Street, in other words, not on sort of like public markets, like the stock market solely, right? And if things get rough, the Federal Reserve will cut interest rates and buy treasury bonds via quantitative easing, right? Not so fast. Even with rates steady, the dollar has dropped 9% since Trump took office. The administration prefers a weaker dollar on the belief that it would boost exports. Mistaken belief, he says. That's an opinion. Meanwhile, imports, especially intermediary parts used in manufacturing, are then more expensive. That, along with tariffs, will likely drive inflation higher, which means cutting rates could further weaken the dollar. Remember when I said in 2022, the dollar rose because rates were going up? People wanted access to our bond market, so they buy dollars to buy our bonds. Well, if rates are going down, go get your yield elsewhere, right? What do you need the dollar for? You could go invest in euros, which some people say might be the new dollar of the future, thanks to some of the actions that we're seeing in markets right now. But cutting interest rates could actually serve to worsen that near-term inflation in a stagflationary environment, while at the same time other foreigners or institutions are cutting their exposure to bonds, which potentially puts us into a self-induced pickle. Consumer sentiment facing 10-year lows, capital spending plans way down, cargo shipments from China to the U.S. are down by about a third, Retail layoffs may start as, empty trucks are here because trucks don't end up, getting hired to deliver empty, freight, obviously. But anyway, Apollo predicts a recession by the summer, blah, blah, blah. A potential scenario, this is the doomsday here. The economy nosedives, inflation rises, that's stagflation. Obviously, after inflation goes up in an economic nosedive, you'll see substantial deflation, but inflation could happen first, temporarily. Profits plummet, private credit implodes. This is a big one because we're about to watch a video on just this. I feel like I'm in high school. Are y'all ready to watch the video? Bill Nye the Science Guy. Okay, sorry. If you were watching that in high school, maybe that's a bigger problem. But anyway, interest rates fall, the dollar drops further, liquidity dries up, and dicey markets lead to struggling times. How do we avoid this? Go back to zero tariffs. Now, I can't disagree with that, okay? We should be going back to zero tariffs. I totally agree, or at least lower tariffs. And hey, if we can negotiate the other tariffs lower, fantastic. I'm worried that Donald Trump is too convinced that tariffs are great, and, we're going to raise so much money. We're going to bring down the debt with all the tariffs, and we're going to cut taxes. All right, we'll see. But this is interesting to me because this right here, I think, is what nobody's paying attention to. Liquidity. With people buying the dip in the most aggressive manner that we've ever seen in American equities in April, I fear that the people's access to liquidity is drying up because people see money and it burns a hole in their pocket and, oh my God, I need to buy stocks. And, then all of a sudden you don't have liquidity when you need it. I think that's why we're seeing Warren Buffett sit on the cash pile that he's sitting in, or sitting on, or I guess now Berkshire is sitting on. So sad. But anyway, liquidity drying up is a really big problem, and it has been drying up. What you're seeing with the Taiwanese dollar is a liquidity issue, and potentially in part a hedging issue, which is also liquidity-based. But anyway, I want to see the full 2-minute commentary here by the Oaktree co-CEO about liquidity and private credit and how that could be a canary in the coal mine. Let's listen in here and we'll have some commentary.
In public markets, you've seen some spread widening.
Yes.
Nothing crazy, but it's there. In private markets,
Spreads widening, by the way, increase of risk.
Public markets, you saw the widening.
And decrease of liquidity.
In private markets, you gave me an amazing statistic that you're seeing some funds being sold 90 cents on the dollar, as little as 70 cents on the dollar. And you told me that this is before the tariff.
The reason, by the way, things would be sold for 70 or even 50 cents on the dollar is because of liquidity. When people need access to capital, they don't mind taking a loss on a certain asset if it means they get cash. This is why Buffett always sits on cash.
Negotiations started.
That's correct. In fact, I probably misquoted the low end. I think it's even lower than that in some cases. We've seen and done trades at, in the 50-cent range. So what I would say is this. If you look at all the major asset classes that we focus on, we're primarily sub-investment grade. It's high yield leveraged loans, it's private credit, and triple Bs. We occasionally look at triple Bs as well. High yield is about 385 basis points over right now. It got as low as 260. It's got as high as 460, so it's right in the middle of its range. Loans is wider of that. Those would imply we're at a very normal state in the credit markets, which I find ironic because this is anything but normal. These are unprecedented economic times. So as you look, I think it is starting to create some desire on the part of large institutional credit holders to get out of this before maybe there's something, before a fall. And that's where
That, I think, is exactly right. This idea of, okay, yeah, retail's buying the dip in April, but we're going to get out before it gets worse.
You're getting credit secondaries. They've been pushing their GPs to get liquidity out of the funds. The GPs haven't done it at the pace that they would like. And now the LPs are taking matters into their own hands and putting credit secondaries out there for folks like us.
That gives me shivers to think about that. Yeah. The 50 cents on the dollar funds are being sold right now. And again, we have not potentially even seen the worst of this economy yet. What does it say about potentially problems that are being masked in private markets, given that we're not seeing daily marks on these types of assets?
Yeah, so I think what it says is, to date, we haven't seen forced selling. There haven't been really dire liquidity situations that people need to address. And so these have been mostly trades of convenience where they're trying to clean up a portfolio that they have. I think we're going to get into more sort of anxious points in time where LPs will want to trade. And I think those discounts will go out further. And they don't, again, those occurred at points in time where there wasn't a lot of credit impairment going on. If we see some of the economic weakness that I believe could happen, you will start to see impairments pick up, and then the discounts will be very large.
Now, they're already seeing discounts as much as 50 cents on the dollar. And now they expect this could be even worse. So I think the catchphrase of the day is liquidity. This is something that I think every investor should really be thinking of. I think there are two ways to look at liquidity. Number one is yield-bearing assets. I usually don't encourage, yield-bearing because, you pay taxes on that. But in recessionary times, I actually think they're great. Like if you could lock in, a 6-month treasury bond or a 1-month treasury bond, or sorry, a 1-year treasury bond and lock in that, 4.25% or whatever. I think that's great because you get your principal back at the end, but then you're also getting the yield in the meantime. And that could be good if you go into a recessionary time where you need to supplement some of potentially uncertain job income or entrepreneurial income. It's one of the reasons why we created the 5% bond at House Hack, where, not only do you get 100% of the upside in the stock, so as our valuation grows, investors get 5%. We created that because we think that in a recessionary style environment, investors should be rewarded with yield and still have, partake in upside. With downside, I think what we're doing with the House Hack bond is incredible, but you can read more about that over at househack.com. It's open to non-accredited investors. But the other option, too, is sort of a combination where you look and you say, okay, well, I'm going to have yield-bearing assets in some extent because I don't want to be completely invested in things that could actually do really well in a recessionary time. But then you also raise cash on the other hand. See, I actually think that recessionary times present really good business opportunities. And if you're an entrepreneurial individual or maybe you're employed and you want to do a side hustle or whatever, recessionary times are really interesting for that because if the businesses that survive in a recession, they usually face less competition coming out of a recession. As an example, I think a lot of real estate companies that are way over leveraged are going to have, a little poopy doopy to face, especially some of the, flippy companies. If we do hit a recession here, I'm not going to be very happy about Open Door as an investor. I'm not an investor in Open Door if I were. And I wouldn't be surprised if you could potentially knock on a bankruptcy door and their software gets picked up for pennies on the dollar. Maybe I'll buy it. But beyond that, recessions create opportunities. And so, I like the Buffett quote, the biggest call option that you could have for an opportunity is cash. And then, of course, I always say the number 2 one of that is cash flow, hence yield. Anyway, thanks so much for watching. Hopefully this was insightful to you, and beware of the liquidity swamp.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.